But for private banks, for the near-term visibility may be a bit foggy, but for PSU banks, I think it's clear blue skies. And let's touch base with the management of Canara Bank now. Satyanarayana Raju, Managing Director and CEO of Canara Bank, now joins us. Mr. Raju, good morning. Thank you for joining us. First, address the concerns that investors might have in terms of your guidance. You have given growth and NIM guidance for FY25, which is below the current growth rate. How should one view this?
Let me clarify to you that if you observe that for the last 3 years, our bank, whenever we give guidance, we give little conservative guidance to the public. And when it comes for that performance, we outperform that guidelines. The last time what we have given 10% in advances growth, you've seen that it is 11.34%. And this time also, though we are given 10%, we are confident that we will achieve around 12% the advances growth. Regarding the NIM also, let me clarify to you. The last time the annual growth and the entire previous financial year, the cumulative NIM was 2.95. But as against that, though every bank has shown a decline in the NIM, we could successfully maintain and even shown the improvement of 10 basis points. And the cumulative, for the next just concluded financial year, our cumulative NIM is 3.05. And the last quarter, fourth quarter, it is 3.07. I have not seen any change in that present setup. But that generally when we communicate, because our CASA is low compared to all other banks, we give our NIM in a conservative manner. But our efforts will continue to maintain around 3. That will continue even in the current financial year. I don't see any difficulty in maintaining a credit growth at 12% or even NIM maintaining at a 3% at this level.
Okay, morning, sir. Coming to the overall numbers, if we're looking at the PPOP growth this quarter, that was low due to the high operating expenses. Where do you go from here on?
Employee cost is a one-time measure because the current financial year, the bipartite settlement has concluded and they have shown given at 17% growth rate. To complete that entire exercise, we don't want to keep anything carry over for the next quarter. Whatever the burden it is there, entire burden we accepted and we settled that bill. And initially, the last quarter also, we provided 450 crores towards the retirement benefits. And that time I shared with all of you, stating that there is another 150 to 200 crores we are likely to provide in the next quarter. But when it comes for that actuals, as for the actuary certification, we are forced to provide 350 crores to complete that entire exercise. So we have provided 350 crores below the line. That's why that operating expenses are showing little higher side. But the staff cost from June quarter onwards, it will be stabilized at 4,000 to 4,100. Whereas in the March quarter, it is 4,450. So that cushion always is there in our balance sheet.
Right. Mr. Narayana, wanted to understand how one should anticipate cost to income. What's your internal target right now?
We just keeping on that when the staff cost has increased suddenly 17%. Earlier, our staff cost used to be around 3,400 to 3,500 per quarter. But now it is reached to 4,000 to 4,100 for that. But otherwise, all other expenses, though another area also for last 3 years, continuously we are investing heavily in the capex of the IT. So when you invest heavily in the IT next year onwards, that will carry some depreciation, some ATS charges, and some operating expenses, 100 to 150 crores will be added in that. These two cumulative together, we feel that we may around 45 to 47% we can manage in our cost to income ratio. We are keeping in mind that is the range 45 to 47%.
So let us also look at the CASA ratio. While it's worth nothing that CD ratio is really at a healthy level. To fuel the CASA ratio, which comes at about 32%, which is well below your guidance of 35%, and you've also reduced your target for FY25. And is competition intensity increasing?
At this moment, with the 31.65% in the December quarter, and we could move to 32.3% in the March quarter, there is a 63-64 basis points we can show that incremental growth in the CASA percentage. This we could achieve it because in the third quarter results announcement, we clearly communicated to you that this quarter our focus will be liabilities, not only the advances, but we focus more on the liabilities. As we shared with you, that we are focused on the liabilities, and we are, to some extent, we are successful on that. So that is the reason our CASA ratio has improved, though the balance sheet size is increased, but CASA percentage also, not only the absolute numbers it is increasing, even a percentage also increased 63 basis points.
And do you think that the cost of deposits may go up from here on?
Deposit has already reached to the peak. Maybe whatever the 3-4 basis points it increases, but simultaneously we get that benefit in the yield and advances also. If you see that effectiveness in the March quarter, our cost of deposit has increased. Incremental increase is 8 basis points, whereas our incremental improvement in yield on advances is 11 basis point because of our rejig in the corporate advances portfolio. So we are taking care of that. So we don't have any too much concern on the cost of deposit. At this moment, we have seen at a bulk deposit side a little softness on the deposits. But retail term deposits, still it is at a high cost. That we expect that in the second half of this financial year, little more softness may come. If that comes, what we have projected is that will be a much better performance. It can be shown in the NIM as well as in the cost of deposit.
Let's also talk about the corporate book now, because RBI circular on the project under implementation is going to impact you. Have you made any assessment on how much could the impact be in terms of provisions?
Actually, out of 35% corporate is, it's not that entire thing is only a project funding. We have approximately 35 to 40% working capital limit is there, around 1,35,000 crores to 1,40,000 crores NBFC exposure is there, and several state government, central government fundings are there, around 65,000 crores to 70,000 crores. So if you remove all these things, a part of that, maybe 20% of my corporate lending, corporate portfolio may fall in this 18 to 20% of my corporate total portfolio. But that again, what I want to say that we need several clarifications that what is there any floor limit for calculating this project as a project for maintaining the provisions? All these several clarifications are required. Both the risk department and corporate credit department, both are working independently. Once they complete their assessments, then they will come together.
Although there are further clarifications required, your corporate loan book growth clocked 11 to 12% growth this quarter. But given these regulatory changes, do you think this growth number will slow down?
Actually, in absolute numbers or in actual purposes, if you see that new sanctions have increased compared to the previous new sanctions in our corporate book. We are getting so many new proposals and we are keeping on underwriting those things. But when it comes for that actual absolute numbers, incremental growth, what we have shown 8.64, and the last quarter we have shown some negative growth, is only because of our rejigging that low yielding advances. We are taking it back. We are not renewing it full amounts. That is the reason. Otherwise, the double-digit growth, definitely it will be there even in the corporate.
And finally, when it comes to asset quality, your net NPAs have increased marginally this quarter. Although recoveries for the bank have been strong, what's the take on NPAs? Are you seeing any stress visible in a particular sector?
If you see that in absolute numbers, the net NPAs have come down. Even sequentially, it has come down from 12,176 to 11,823. If year on year, if you see that it has come down from 14,349 to 11,823, more than 2,500 crore in absolute number, it has come down. In the current financial year, last quarter, that has come down maybe less than that what we expected is. That's because you are having a burden in the form of operating expenses in the form of staff salaries and all those things. No, you can't take everything at once in one quarter. So in the coming quarters, we see that a further steep decrease in this net NPA. What I want to highlight it is, you see that what the guidelines we have given last time, that also one year back, that our main motto is our slippages should be less than our recovery and upgradation. You see the fourth quarter also, our slippages is 3,400 crores. Our recovery and the upgradation together is 3,680 crores. So we are maintaining that. When we, without touching the writing off, and in absolute numbers, our recovery and upgradation is more than our slippages. That thumb rule we are implementing quarter on quarter, that is giving a better results.
Right, Mr. Raju, great to have you on the show. Thank you so much for taking the time out and speaking with us today. Let me now...
If you like this video, then like, share and subscribe to ET Now.